This presentation is going to focus on stocks. You can find stocks in your textbook, section 1.3. Stocks are also known as shares or equity, so these words sometimes are used interchangeably. As always, we're going to start off with those three things that will help you differentiate stocks from everything else that you're learning in the segregated fund module. And those three things are ownership, capital gains and losses, and transparent or transparency. So stocks actually represent ownership in a corporation or company. So when you are purchasing a stock, you're actually purchasing a piece of that company. And so you get to participate in the growth and decline of that company's value. And stocks can be found in segregated funds, whether it be an equity, balanced, or a growth seg fund. And there are a few things that indicate whether the stock price is going to change or why the stock price has changed. And the first is macroeconomic. Macroeconomic specifically focuses on the economic conditions of a region or a country. So if you want to think macro, think bigger, a whole country or a whole region. Whereas microeconomic focuses on a single product developed by one company and what's happening within that one company. The other big thing that does affect the stock price is investor feelings. So this is one of the big indicators, because if you find that the investors or people in general, the public, are starting to turn against a stock or a company, a corporation, then you will find that their stock prices do start to fall. And then the opposite, if they're really enjoying and liking what a company is doing and feel that they want to continue to support it, you will find that their stock prices increase. Stocks are sold by an investment dealer or a discount broker. The difference between an investment dealer and a discount broker is that an investment dealer actually provides advice to the client. So they will give some information and really help the client figure out what the best option is for them. Whereas a discount dealer just does the trades and does not give any advice to the investor. So investors do pay a commission for both buying and selling the stocks. And so every single time that happens, they are paying a fee. There are also KYC requirements to make sure that the level of risk and the timeline matches with what the investor is looking for. And stocks, you can put them in either registered or non-registered accounts. Returns from stocks can be received as either capital gains or losses, depending on whether the company is doing well, and then also as dividends. So dividends, every company does not pay out dividends to its shareholders, but it is possible that shareholders will receive dividends. Now, there are two different types of shareholders: preferred shareholders and common shareholders. Preferred shareholders do receive dividends first, and so there's a little bit less risk affiliated with being a preferred shareholder, because you are guaranteed, if there's a dividend payout, to receive that dividend payout before the common shareholders. Now, there are several different types of risk affiliated with stocks. Loss of capital. So remember, a stock, you are putting your money in, it's possible that you could lose absolutely everything. So there is a risk affiliated with that. There is also market and industry risk, and then there's also a possible currency risk, depending on whether you're investing in stocks that are in a local currency or whether they're in a different currency. Now, there is a range in risk for stocks. The least risky stock is a blue chip stock. And blue chip stocks are typically from large, well-known and established companies that people really have a lot of confidence in. As opposing that are penny stocks, which are the highest risk stocks. Now, those generally are under $5. They're very illiquid. They're highly speculative, and they really are companies who people might know or not know, but it's a risk. They feel that the company might be doing something new that they don't have a lot of confidence in, or it could be a new company that they've just never heard of before. The protection affiliated with stocks, or the protection that your investors get when they invest in stocks, is just the CIPF. So that is, remember, just if the company goes through, if there's just bankruptcy. It's not, I've lost some money in my stock and so I want to use that protection. This protection is only as a result of the company going bankrupt. So advantages and disadvantages of stocks, and you're going to see some of these sort of go hand in hand. So there are increases in the value of the stock or decreases. And with those increases, there is some favorable tax increase as well as the decreases. So they are considered capital gains or losses, which means that as an investor, you're only being taxed on 50% of that gain that you receive, and you can use the capital losses to offset any capital gains that you might have. There is a high level of transparency and liquidity. So liquidity, and you're going to see this, we're going to talk a little bit more about it in the disadvantages, but liquidity, you might not be able to sell the stock at the value you'd like, but you will always be able to sell it. Next, we're going to go through some of the disadvantages. So a couple of the disadvantages that there is a lot more risk with stocks as opposed to investing into something like a mutual fund or a segregated fund. And this is because you can lose everything that you have invested. So it is possible you really have no idea what's going to happen when you invest in a stock. There are also commissions on each and every trade. So every time there is a purchase or a sale, you do have to pay a commission to either the investment dealer or the discount broker. There can be a lack of diversity. So if you're investing with a discount broker and you are really not paying as much attention or you're not aware, you could be investing in too much in one region or one industry, and that could present a lot of risk and lack of diversity. This is not an insurance product, so there is no ability for the investor to rescind their sale, so to sort of go back if they don't want to do it anymore and undo it. And you also cannot name a beneficiary, so all of the benefits that come with naming a beneficiary you do not have with stocks. And then last, the sales values are not guaranteed. So we sort of touched on this in advantages. The sale value is whatever it is at that time. So there's no way of knowing what it will be when you decide that you need to sell it. And if you are in an emergency situation, you might not end up getting the price that you want, whether it's that you've taken a loss or you just haven't sold for as much as you were hoping to. There's no guarantee affiliated with that. So that's it for stocks. If you would like any more information, please check your book, section 1.3.